explain when people how significant, because 0.2% doesn't sound like very much. If we're talking about pay rises, that people would say that wasn't enough. 0.2%. Explain, put that into some context for us, and how this could mark the start of the recession, but we just don't know yet.
Yeah, so as you say, like 0.2% is like almost within the margin of statistical error. So it's potential that the data will be revised. That happens to some previous forecasts that they were revised upwards by maybe about that amount. So whether technically we will be in recession already or not, it's not fully confirmed yet. But I mean, I think as you referred to earlier, the Bank of England longer-term forecast, which goes beyond those immediate statistics, that's the recession coming. So whether this has technically happened already or whether it's coming next month, I mean, unfortunately, it looks like the trajectory is going in that direction if we persist with the current policies and, subject to what the Chancellor does in the upcoming budget. So I would be worried as well, actually, about where we are heading, even if this relying on this like short snapshot data is not fully confirmed yet.
And when we talk about a recession, it sounds bad. Everyone knows it's not a good thing. Explain what it means in the real world. If we are in a recession, and it's a long recession, i.e., the economy is shrinking month after month after month after month, what will that mean in real terms for real people?
Yeah, that's excellent question. What would it be like? So one of the aspect of recession would be rising unemployment. So something that the Bank of England also predicts. So more people would be losing their jobs, and when unemployment is rising, that also puts further downward pressure on wages. So the wages, well, nominal wages have been increasing recently, but actually they were lagging behind by quite significant margin behind inflation. So in fact, people were already experiencing significant pay cuts, but that happened with what the Bank of England describes as a very tight labor market where unemployment is pretty low. So employers to a point have to compete for workers. But when unemployment is increasing, that pressure is reduced. So there will be further downward pressure on wages. So even if people don't lose their wages, they may be at risk of not receiving pay rises, even to an extent that partially offsets the high inflation. Here we have a bit of a policy choice for the government. If the policy decisions actually deepen the recession further, that can create a sort of like a negative spiral, because the more people lose their jobs, the more people lose their income, the less spending will be the real economy. So people who depend on the spending, so firms, who want to sell their things, retail shops, pubs, what you have, they will have reduced income. So then, that can create a bit of a negative spiral that, more jobs will be at loss. So it's very crucial that the government, with the policy response in the budget, kind of considers not to make the situation worse with overdrive towards austerity and cutting public spending, which is, another element that will reduce the amount of money in the economy, which can put further pressure on more job losses and declines in incomes.